Hey, it's Chris Goff, and in this training video, I want to teach you how to analyze multiple exit strategies so you can see which way is best and which way has the highest return. And you should do this on every deal with any strategy. The reason I wanted to put this training together is because I've had so many requests. And look, I get it. Understanding the numbers is what this business is all about. Sometimes we get caught in the moment of watching a video or TV show where someone is rehabbing and flipping, and you say to yourself, hey, I want to do that, but is that the best way financially? Look, every deal is different, and every seller is in a different situation. I just don't want you to have this one-shoe-fits-all approach. And I want you to be in the best position educationally to fix multiple problems and have multiple ways you can make money. It just makes sense. So in this example, we have seller financed a home, and now we need to determine what our exit strategy is. You're going to have a front row seat as I go through each exit strategy so you can learn which way is best for you and your goals. Now, if you're unfamiliar with seller financing, I have a training video that you're going to love. You can find this video in the description below, or if you're an REIPro member, you can find all of my seller financing training in the strategy video section. And if you haven't already, you should consider subscribing because my passion is to share my expertise over 20 years to help you create a stronger knowledge base and a profitable career as a real estate investor. Okay, let's jump in and learn how to analyze multiple exit strategies. So I'm inside REIPro and in our multiple strategy calculator called REIPro. And if you've been following me, you know that I'm not a one strategy fits all approach. I work multiple strategies because I want to see how I can profit in different ways. This way I can make the best financial decision as well as satisfying my personal situation. I could be an investor that says, hey, I can wait, years down the road to actually see a good return on this investment. Or I could be the investor that says, hey, look, I need to make cash today. Or maybe you're somewhere in between. This is what I love about this calculator. So let's start analyzing this deal. So just to recap, I'm actually seller financing this from the owner, meaning that the owner is deeding me the property under these terms and becoming the bank. So first we need to look at how we're acquiring the property and select seller finance. And as you can see, I've already filled in the numbers just for time's sake, but let's go through this line by line. So the very first thing is our after repaired value here you can see at the top, which is $275. Now, of course, we ran comps and similar sales and feel that this property could sell for in tip-top shape at $275. Our estimated purchase price, which the seller agreed to, is at a $225,000 price. The property is 1,450 square feet, which gives us a cost per square foot $155.17. As we scroll down, you're going to see the repair costs. So we've gone through the property, we've inspected it, we've calculated all the repairs and estimated this to be $20,000. Next is our hedge expense, and I always like to use 10%. Now this is 10% of the estimated repair cost, and this is more or less just a buffer. You always start to do these rehabs and there's always some hidden costs you didn't see from your initial inspection. So the good thing about using a hedge expense is that number one, if you do have these extra hidden costs, you've already calculated that with your offer with the seller. But if you don't, then that's just going to make you a little bit more money. The estimated repair period, we feel that would only take 1 month to actually rehab this house and put it in tip-top shape. As we scroll down to the other cost, you're going to see what we call a monthly holding expense. Now, if you hit this little plus symbol, you can see what these expenses are, such as your utilities, lawn care, and any other fees here. So I've already went in and broke this down. You can also just throw in a number here. Next are our closing costs. So, we have to close with the seller since they're going to be deeding us the property. If you hit the plus sign, you could see these expenses broken down here, but I just put in a closing cost at $950 because I'm already familiar with what things cost in my area. And I know that the closing attorney is roughly going to be $950 for this entire closing. Now, this number is going to change depending on where you live in the country. So it's a great idea to start building a relationship with a title company or closing attorney and get an estimate of what these closing costs will be where you live. Next is our property insurance. So this would be based on a yearly, so $1,200, and our property taxes, $23.92. This property is not in an HOA, so we're not going to put anything here. Now we're going to scroll down to our financing. So the seller agreed to a sales price of $225 and a $5,000 down payment. Now keep in mind, of course, we want to get in with little to no money because we have to make money. And especially when we're going to put money back into the property from a rehab standpoint, we don't want to put much money down. They agreed to a 4% interest rate. It's going to be amortized over 30 years to keep that monthly payment down, but have a balloon payment, a term of 5 years, meaning that I have today all the way up to 5 years to actually cash the seller out. So I'll be making monthly payments to the owner. And then when I'm ready to buy, or my new buyer buys it from me, I can then amortize our balance with the seller and pay them off. Now let's look at a couple of different ways that you can actually get rid of this property, which is choosing your selling strategy. Now I'm going to go into all 4 different ways, but let's look at the sell flip. What we want to do is seller finance it from the owner on the left side, and then the right side, we're going to sell it. So the first thing we want to do is put in an estimated asking price. Well, we already know the ARV is $275. So of course we're going to max that out. Next is, how many months do you think it's going to take to sell this property? So keep in mind, we're rehabbing the house, which is going to take 1 month, but then how many months is it going to take to sell? So we estimate this to be 2 months. Next, we have marketing costs. So if you just drop that down, you can see staging, advertising, and any other cost. We put in $500 here for staging. And then you're going to have selling cost, right? So you got to get rid of it. So I already know the closing is going to be $950. So I just threw this number underneath the attorney's fees. But we're also going to be using a realtor, and that total commission would be 6%. Now, that would be assuming that the buyer is bringing in an agent to represent them as well. Now we can actually analyze how we did on this project. So you can see the total loan amount here at the top, $220. Cash required for the project is going to be $34,000. Keep in mind, we have a down payment, we have our repairs, we're going to have closing. We have a lot of expenses over here that's going to take cash out of your pocket. So right over $34,000. You can then see the total loan payments. The term of the seller is going to be 5 years. So the balance after 3 months is going to be $219. Because keep in mind, we're estimating this total project to be 3 months. Here you can see the purchase price of what we're buying it for at $225,000. Total repairs we estimated at $22,000, so that's $20,000 plus the hedge expense of $2,000 gives us $22,000. Total holding time is going to be 3 months, so we have 1 month of rehabbing and 2 months of selling. Total other costs $39.48 and a marketing cost at $500. Now we're turning around and selling this property to a new buyer that's going to live in the house for that $275. So if you calculate all the numbers, your total net profits almost $4,000 with a ROI of 1.53% and cash on cash return 11.29%. So when I'm going through this, do I really feel that it's worth me putting all the time, all the money into this property just for that return?
No way!
Now, of course, you could increase these numbers only if the seller was willing to take less on the property. So this may not be our best exit strategy with how we're acquiring it. Now let's go look at some other ways or other strategies that we can use. And the next one we're going to do is rent. So in the rent analysis, we've owner financed it from the owner. Now we're going to turn around and use it as a long-term cash cow and rent this property out. Monthly operating income is going to be the rent. So we know that it can rent for $2,000. Estimated vacancy we put in at 10%. And a monthly operating expense of $100. Now, you have a ton of things in here that you could fill out. I just know for this particular property, it would only be $100, so I just put it here. So I've taken, here's our total income coming in on the property and our total expenses on this property. If we scroll down to actually see how well we did, you can see the annual cash flow at $4204.28 and a cash on cash return at 14. Now, this could be a great exit strategy if you're looking at it from a long-term point of view. Obviously, with the tenant being in there for up to 5 years, they're going to be paying down the debt. And at the same time, you're going to have a cash flow of $350. Now let's look at another exit strategy, which would be a lease option. So here we're going to lease the property out to a tenant buyer for a 12-month period of time where they have the option to buy it. So they're going to be making rental payments to us, get their credit in line, get their cash required in line to qualify for a bank loan, and then cash us out. So we set the sales price at the very top of the market here at $275. Now, technically, I might be able to go up just a little bit, especially if things have been appreciating, because this is 12 months down the road. The cash price is $275 today, so technically I could go up because it could change 12 months from now. Next is our option payment of $10,000. So this is a non-refundable down payment that's credited to the purchase price if the buyer buys. The monthly rental payment is going to be the $2,000, just as if we were renting it. In this case, I'm not going to use any monthly credits, but if you do use them, you want to keep them low. So if you put in $100, what that tells the buyer is that every month that they pay on time, they're going to get an additional $100 credit towards the purchase price on top of the option payment they put down. We're always going to set a lease option term for 12 months. Now, keep in mind, we have 5 years with the seller, but in a lease option, I only put the term at 12 months. Could I extend it another 12 months? Absolutely. Could I find somebody else for the property? Absolutely. Could I just rent it the second year? Absolutely. Could I just sell it the second year? Absolutely. So you have multiple different options if the buyer doesn't buy. If we scroll all the way down here, you can go through the numbers, but our total net profit is going to be $37,000 doing a lease option. So here we've owner financed it from the owner. We've turned around and did a lease option. 12 months later, the buyer cashes us out, which in turn cashes the seller out. We have a net profit of $37,000. So if you're the investor that's saying, hey, look, I'll take a little bit of cash flow right now, but I can't wait 5 years down the road to make any money on this. This might be a great exit strategy for you. And the last exit strategy we're going to look at is seller finance. So here we've seller financed it from the owner, and now we're seller financing it back out to a new buyer. So the estimated sales price here, again, we're going to go tip top at $275,000. We're estimating a time of 1 month to sell. Typically, we can get a seller finance buyer much faster than we could if we put it at a retail price selling it to a qualified buyer. Now, of course, every market's going to be a little bit different. We're going to set the loan amount at $275,000 with $20,000 down. Now, anytime that I seller finance a property back out to a buyer, I always ask for more money down than if they did a lease option. We're going to set the loan interest rate at 5%. Again, we're going to amortize it over 30 years, just like we did with the seller. But the balloon payment, we're going to set that term at 3 years. So we have 5 years with the seller, but only 3 years with the new buyer. And if they can't buy or something happens, you have another 2 years to do something with the property. You can see the insurance and taxes are pretty much going to be a wash for us. They're just going to carry over to the new buyer. Again, no HOA dues, and you can see what their loan payment's going to be. So here we're going to just break out the complete analysis by here's the terms that you have with the seller, here's the terms that you have with the new buyer. But all said and done, if we go all the way down to the bottom, we could see a total net profit of just over $23,000 with a 9% ROI and a 72% cash on cash. Keep in mind, you're getting a lot of that cash that you spent to acquire the property back through the down payment that they're making. So if you're an investor that says, hey, you know, Chris, I don't want to worry about tenants, toilets, headaches, maintenance costs, repairs, a seller finance might be a great route for you. And as you can see, over time, you can make some pretty good money on it. And your cash on cash is really great in this particular exit strategy. Hey, thanks for watching. And if you learned something valuable, please click that like button. It really helps me out. And be sure to check out my seller financing training video. You can click that link right here. And I look forward to seeing you on the next training video.